What's up, you guys? This is Paul here. Welcome back to the Options Income Strategies channel here. In this video, I want to talk about how you can best use options trading to trade stocks in this current volatile stock market. Okay, so before I get into that, I want to give a quick update on my portfolio here. As you can see, year over year, we're at about 35.7%. We're clearly outperforming the stock market, which is always my primary goal. So I'm very happy about that. So the difficult thing about trading in this current volatile stock market is that the market is really very volatile, as you can see. There's so much news that's going on about the pandemic. We don't really know when we're going to have a vaccine. We don't know the situation about the lockdown yet. We see that different states are slowly easing the lockdown policies, but you also have health officials telling us that if they lift the lockdown too quickly, then we're going to have a second wave and the infections are only going to grow exponentially. So in a time like this, the fact that the stock market still keeps going up is honestly, in my opinion, quite ridiculous because most banks are estimating that GDP will go down by as high as 34% in the second quarter, which is one of the worst that we've ever seen. So considering the economy is so terrible, there's lockdown, that unbelievable amount of unemployment, there's not a whole lot of consumer spending. It honestly doesn't make sense that we're almost back to all-time highs, or year over year we're barely down. So in my opinion, that doesn't make sense at a time like this. I think the stocks are really overvalued. I think the money printing by the Fed is what is really keeping the stock market up, but as you all know, that can't keep going on forever. So, in my opinion, I think the stock market is overvalued. Whether a big crash is going to happen or not, I don't know that yet, whether we retest the lows, but honestly, now is a pretty scary time to really invest heavily in the stock market. So, the best way that I'm using options to trade in this volatile market is to use what are called credit spreads. Okay, so in my previous video I talked about a put credit spread that I used on Zoom. So let's see how that's doing so far. So in the previous video I told you that how I bought 4 put credit spreads on Zoom, uh, where I bought 4 $95 puts and I sold $410 puts. Now, as you can see, I got these contracts on April 20th, and in just less than a month, it's up 76.47% for a profit of $1,040. Now, this spread doesn't expire till June 19th, but the break-even price for this spread is only $103. Considering the stock price is at $175, the odds of Zoom, which is actually benefiting from the current lockdown, the fact that the odds of it dropping from $175 to $103 in the next 1 month are extremely, extremely low. The only time they saw any kind of a scare was when people started talking about Zoom bombing, all the security issues, and a lot of companies and schools started recommending that their employees stop using Zoom for collaboration. But what I really love about Zoom is that their CEO is extremely proactive and accountable for the different issues that they're seeing on their app, which is why they instantly kicked off rapid measures on how they can tackle these security issues, which is why the stock is back up now. They've already created end-to-end encryption, they've already made it password protected, and now all the security issues are gone, which is why the stock is moving back up again. Okay, so the odds of it dropping to $103 in the next 1 month, which is what, over a 40% drop, I think the odds of that are really low. And the way this option strategy works is that as long as the Zoom price stays above $103 by June 19th, I get to keep the full credit of $1,360. And the way I calculate $1,360 is the overall credit that I got when I initially put this strategy together. Okay, so another way to calculate it from looking at it here is the difference between these two, which is $80. Okay, $80 times 4 is 320. You add 320 to 1,040, that is 1,360, and that's the overall credit or profit in this case that I can keep if Zoom price stays above $103. Okay, and I also own 15 shares, and we're still up 48% on that, which is $855. And also, my initial average cost was around $70, and I kept taking some profits along the way and buying back, which is why my average price has gone up. But I already previously locked in about a $560 in profit, so we're doing really good on Zoom stock. Now the beauty of this is if the price of Zoom does drop from 175 back to 118, which is my average cost basis here, my entire profit from just owning the shares will drop to zero. But the options will still give me $1360 because the price is still about $103. Okay? And that's really the beauty of using put credit spreads where you're locking in income whether the stock price goes up or down. Okay? Another example is the SPY. Now this essentially tracks the S&P 500 index. So even the S&P 500 index has been really volatile because it essentially tracks the market. Okay, and I bought a couple of options. In the first video, I talked about how I bought 5 297 calls and sold 5 292 calls. Okay, and the credit from that initially was around $1,000. Okay, but the SPY started really going up earlier this week before it started going down again, and SPY reached around $294, which was the break-even price for that spread. So what I did was I actually bought back two of those put credit spreads where I had to spend about $580, but I pushed out that spread to by buying a 307 calls and selling 302 calls with a break-even price of $304 and got an additional $210 in credit for that. So if I subtract the $200 credit from the $580 that I had to spend to close the two of those initial spreads, that gives me a profit of 580 minus 210 is about $370. So that $370 is not a loss, remember, because we got an initial credit of $1,000, and now as long as the price of SPY remains below 294 or below 294 essentially, I still get to keep the full profit of 1,000 minus $370, which is $630, which is still pretty awesome. Okay. Same thing with VOO, which is the Vanguard Index Fund. In the first video, I talked about how I bought 5 285 calls and sold 5 280 calls and kept a credit of $555. And this breaks even only at $282 for the week for VOO before June 19th. And clearly, we're still way off from $282. And I think we can profit from that too. So that's how I have been trading in the stock market, guys. There's just too much uncertainty in the stock market right now, too much money printing going on. The Fed is artificially keeping the market up, even though the economy is absolutely terrible. So in a time like this, when you're not really sure whether the market can keep going up or if it might start going down, this is when you can keep profiting and seeing great returns, like you can see right here, about 35% year over year, even in terrible economy. Okay, thanks for watching, guys. That's all I wanted to share for today. If you have any questions or comments, please leave them below. Smash the like button, that will really help out the channel, and don't forget to subscribe. Okay, thank you and have a great day.